The world of cryptocurrency pulses with an energy that's hard to ignore. It whispers promises of quick riches, of a financial future unbound by traditional systems. For many, this allure is intoxicating, drawing them into a whirlwind of speculation, chasing the next big surge fueled by headlines and social media buzz. But beneath this vibrant, often chaotic, surface lies a critical truth. Not all that glitters in the crypto space is gold. The vast majority of investors, caught in the excitement, overlook the very data that could truly define their success or failure. Benjamin Graham, the venerable father of value investing, once guided us to look beyond the mere market price and seek out the intrinsic value of an asset. This profound wisdom, penned decades ago for traditional markets, resonates with an even greater urgency in the realm of cryptocurrency. Here, where volatility can be extreme and narratives shift with breathtaking speed, a rigorous, data-driven analysis is not just beneficial, it's essential. We've become accustomed to a financial world where hype often drowns out substance, where the emotional pull of potential gains overshadows the quiet strength of fundamental truth. This journey we embark on together is not about chasing the ephemeral dream of instant wealth or predicting the next speculative frenzy. Instead, it is about forging a different path. It is about equipping you, the discerning investor, with the analytical rigor and the critical mindset to see beyond the noise. We aim to transform your approach from one of hopeful guessing, swayed by the winds of market sentiment, into a deliberate, informed decision-making process. We will uncover the overlooked data points, the quiet signals that truly dictate the fate of a crypto asset, guiding you towards sustainable value in a landscape often dominated by fleeting trends. What truly separates a lasting digital asset from a speculative fad? Let us begin to understand. Let's peer into the very engine of a cryptocurrency, its blockchain. We often see projects boasting massive follower counts or viral social media campaigns, and it's easy to be swept up in their tide. But these are like the glittering shop windows of a business, telling only a fraction of the story. The true pulse, the actual heartbeat of a cryptocurrency, lies not in the echo chamber of social media, but in the raw, unvarnished data etched onto its blockchain. We need to look beyond vanity metrics and focus on what truly reveals genuine utility and adoption. Consider the analogy of a thriving city. Would you judge its vitality solely by the number of people who say they live there, or by the actual volume of goods moving through its markets, the number of businesses operating, and the ongoing development of its infrastructure? In the crypto world, on-chain activity is that measure of trade volume and infrastructure development. Metrics like daily active users, the sheer volume of transactions, and the rate of developer commits tell us if people are genuinely using the network, building on it, and contributing to its growth. This is the data that separates a project with real legs from one built on hot air and speculation. The myth we must dismantle is that high social media engagement automatically translates to a robust, valuable project. Many ventures can inflate their community numbers, creating a powerful illusion of popularity, while their underlying network activity remains stagnant. It's a classic case of the market's noise drowning out the vital signal. Understanding this distinction is paramount. It's about looking at the transaction logs, the active addresses, the actual economic activity, rather than just the cheerleading. This deep dive into network activity is akin to a forensic accountant meticulously scrutinizing a company's cash flow statement. It's not about the charming sales pitch, it's about the verifiable substance. It's where the intelligent investor finds the bedrock of truth, stripping away the superficial gloss to reveal the operational health and genuine demand for a digital asset. This is the data that truly matters. Beyond the immediate buzz of network activity lies another critical, often overlooked layer: tokenomics. This isn't merely about supply and demand in a vacuum. It's the fundamental economic architecture of a cryptocurrency, the very blueprint that dictates its long-term viability and value. To truly understand a crypto asset, we must dissect its tokenomics with the precision of an engineer examining the structural integrity of a building. Imagine a magnificent skyscraper. Its facade might be breathtaking, its location prime, but if the underlying architectural blueprint is flawed, if the foundations are weak or the materials are substandard, that structure is destined for collapse. Similarly, a cryptocurrency with a poorly designed economic model, no matter how much hype it garners, is built on shaky ground. Tokenomics encompasses crucial elements like inflation or deflationary mechanisms, the carefully considered vesting schedules for early investors and the development team, and the actual utility the token possesses within its own ecosystem. These factors are not minor details. They are the bedrock upon which sustainable value is built, or tragically undermined. A common misconception is that an unlimited supply inherently dooms a cryptocurrency, while uncontrolled inflation can indeed be a slow death sentence, leading to a devaluation that outpaces any potential demand growth. The truth is more nuanced. Scarcity alone doesn't guarantee value. It is the well-designed scarcity, or a controlled inflationary model that is carefully balanced with utility and ecosystem growth that truly matters. We must debunk the simplistic idea that simply having less of something automatically makes it valuable. It's the purpose and management of that supply that dictates its worth. Therefore, developing a checklist for evaluating tokenomics is an essential step for any serious investor. Ask yourself, what is the total supply, and is it fixed, capped, or inflationary? What are the projected inflation rates, and how are new tokens distributed? Most importantly, what is the token's actual utility, and is it intrinsically linked to the network's core function? Understanding these elements is like understanding the engine of a car. It's the core mechanism that drives its performance and longevity. To ignore tokenomics is to buy a vehicle based solely on its paint color, a gamble no rational, intelligent investor would ever contemplate. The word decentralization is a siren song in the crypto space, a promise of freedom and power to the people. Yet, like many alluring concepts, its true depth and meaning can be easily obscured. Not all blockchains are created equal. When it comes to this foundational principle, we must look beyond the mere claim of decentralization and delve into the metrics that reveal its genuine extent. For this is what underpins a network's resilience and its ability to resist censorship. Consider the structure of governance. Is a system truly decentralized if it's effectively controlled by a single entity or even a small handful? Imagine a nation governed by an absolute monarch versus one where power is distributed and representative. The latter is inherently more stable, more resilient to the whims of a single leader, and better equipped to weather societal storms. In the crypto world, this translates to analyzing the number and distribution of validators or miners, the degree to which the community truly governs the protocol through voting and proposals, and how concentrated control remains within the hands of the core development teams. These are the indicators of true censorship resistance. It's a common trap to assume that simply existing on a blockchain equates to meaningful decentralization. Many projects trumpet their decentralized nature while, in reality, a significant portion of control rests with a few large stakeholders or the original development group. Identifying these concentration risks is a crucial, yet often overlooked, part of diligent analysis. We need to investigate beyond the marketing materials. How do we assess this depth? Research the distribution of stake tokens among validators. Are they clustered in a few large pools or spread widely? Examine governance proposals and the voting patterns that emerge. Does the community genuinely influence decisions, or is it a mere formality? Investigate the core development team's transparency and their role in protocol upgrades. True decentralization isn't just a buzzword. It's the bedrock upon which crypto's revolutionary potential stands. Without it, a project risks becoming just another iteration of the very centralized systems it initially sought to disrupt. This is the digital equivalent of a margin of safety, a vital component for any intelligent investor. In the digital frontier of cryptocurrency, code is not just a set of instructions. It is the very law that governs the movement and security of capital. While the allure of innovation and potential returns can be dazzling, it is the fundamental integrity of the underlying code that acts as the unseen guardian of your investment. We must look beyond the marketing gloss and delve into the critical importance of independent security audits for smart contracts, the transparency of open source code, and a project's history in mitigating exploits. These are direct indicators of a crypto asset's potential to preserve capital. Consider the security of a traditional bank. Its strength isn't merely in the concept of a vault, but in the quality of the steel, the sophistication of the locking mechanisms, and the rigor of its regular inspections. For cryptocurrencies, independent security audits and the integrity of their code serve as the digital equivalent of these robust safeguards. They are the unseen guardians, meticulously examining the complex digital architecture to identify and rectify potential weaknesses before they can be exploited. A dangerous assumption that many investors make is that popularity equates to security. The truth, however, is often starkly different. Many high-profile hacks and devastating exploits occur on platforms that have achieved significant prominence. We've seen time and again how seemingly established projects can fall victim to vulnerabilities, leading to catastrophic losses for investors. Thorough code auditing, a practice that often takes a backseat to marketing efforts, could have prevented a great deal of this financial distress. Therefore, your due diligence must include a keen eye for security. Always seek out recent, reputable third-party smart contract audits. Look for projects that actively engage with the community through bug bounty programs and demonstrate a history of promptly addressing any identified vulnerabilities. Explore the project's GitHub repositories to assess the quality of its code and the nature of community contributions. Ignoring code security in crypto is akin to investing in a building with a known, unaddressed faulty foundation. It's a gamble that runs counter to the very principles of sound risk management, a principle that any intelligent investor, guided by the wisdom of Benjamin Graham, would unequivocally condemn. The world of cryptocurrency operates on the cutting edge, a space defined by rapid innovation and a spirit of disruption. Yet, even in this digital frontier, the external forces of regulation cannot be ignored. The regulatory landscape is not static, it is a constantly shifting terrain, and understanding the potential future frameworks is as critical to a project's long-term success as its current network activity. We must examine a project's legal structure, its engagement with regulatory bodies, and the potential impact of upcoming legislation on its viability and its ability to achieve widespread adoption. Consider the analogy of building a business in the physical world. If you were to construct a factory without any regard for zoning laws, environmental impact studies, or building codes, you would inevitably face significant roadblocks. Eventually, your operation would be halted or forced into costly and disruptive changes. For cryptocurrencies, regulatory clarity, or conversely, the persistent ambiguity surrounding it, acts as the crucial zoning law and building code that dictates where and how a project can legally operate and scale. There's a pervasive myth that regulation inherently kills innovation. While it's true that overly restrictive or poorly conceived regulations can indeed stifle progress, the reality is often more nuanced. Clear, well-defined regulatory frameworks, thoughtfully implemented, can actually foster mainstream adoption and bolster investor confidence. They provide a stable ground upon which legitimate businesses can build and grow. Projects that engage proactively with regulators, demonstrating a commitment to compliance, are often signs of a mature, forward-thinking entity that understands the importance of operating within established societal structures. To assess this aspect, research the legal domicile of the project's foundation or core operating entity. Look for public statements or actions that indicate proactive engagement with relevant regulatory bodies. Critically consider how current and potential future regulations, such as securities laws or anti-money laundering (AML) and Know Your Customer (KYC) requirements, might impact the token's defined utility and its ability to be listed on major exchanges. Navigating regulatory foresight isn't about fearing compliance. It's about understanding the external forces that can either propel or cripple a digital asset. It's the macroeconomic lens through which a truly strategic investor views the long game. We have journeyed together, moving past the dazzling, often deceptive, surface of cryptocurrency hype. We've peeled back the layers of speculation to reveal the essential data points that truly determine the fate of a digital asset. Remember, it's not about the fleeting headlines or the loudest voices on social media. It's about the quiet strength of the network's pulse, the integrity of its economic architecture, the depth of its decentralization, the robustness of its code, and its readiness to navigate the evolving landscape of regulation. Warren Buffett, a figure whose wisdom transcends market cycles, famously advised us to invest in what you understand. This principle is not just relevant, it is absolutely paramount in the volatile world of crypto. By focusing on these 5 pillars: network activity, tokenomics, decentralization depth, code integrity, and regulatory foresight, you are not merely gathering information. You are constructing a framework for genuine comprehension. You are actively transitioning from a position of hopeful speculation, tossed about by market whims, to one of confident, informed decision-making. This shift is fundamental. The path of a successful crypto investor is not about possessing a crystal ball or predicting the unpredictable with certainty. Instead, it is about the disciplined, systematic analysis of underlying fundamentals. It is about the courage to look beyond the noise and engage with the data that speaks truth to value. Armed with this data-driven approach, you are better equipped to navigate the inherent complexities and volatilities of the crypto market. You can move forward with greater conviction, building not just a portfolio, but a more sustainable and resilient financial future. The power to discern true value lies not in predicting the future, but in understanding the present with clarity and rigor. What will you choose to understand next?